We've now built a complete financial model. We have grown assumptions, revenue streams, cost of sales, operational expenses, salaries, and capital expenses, all feeding into a connected picture of how the business performs over the next 5 years. What are the positive and negative variances, even? Now, we are moving into one of the most important sections for any founder thinking about raising money: valuation. This section helps you answer a question that every investor will ask: how much is your company actually worth? And more importantly, it helps you think about that question from multiple angles so you can walk into an investor conversation with a clear, defensible answer. We are on the valuation page. To see the valuation page without the pop-up, we first need to complete Berkus Method and risk factor method. Let's start from Berkus Method. This is one of the simplest and most well-known ways to value a pre-revenue startup. It works by asking 4 yes or no questions about your business. Do you have a prototype? Do you have a quality management team? Do you have a strategic partnerships? And do you have an early sales? Each yes answer adds a fixed amount to your estimated valuation. In this example, we have a prototype and early sales, but not yet a quality management team or strategic partnership. This method is useful for very early conversations where there isn't enough financial data to run a more sophisticated analysis, and it's quickly show investors what foundations you already have in place. The second method is the risk factor method, which is more detailed and goes deeper into the specific risks that could affect your business, but is done every time by analysts that work for investors or AI nowadays. It works through 10 steps, starting with 2 context setting questions: your management team and the current stage of the business, and then working through 8 specific risk factors: legislation and political risk, market size and growth potential, traction and progress, product or service uniqueness, sales and marketing risks, competition risk, litigation risk, potential lucrative exits. Okay? For each factor, you assess the level of risk, and the model adjusts the valuation up or down accordingly. When you've worked through all 10 steps, you click calculate valuation, and the model proceeds a valuation estimate based on your risk profiles. It gives you a valuation that can be explained and justified factor by factor, which investors find credible if you don't overestimate or underestimate your startup risks. Now let's press calculate valuation, and we are moved to the main dashboard. At the top, you will see 4 tabs: dashboard, Berkus method, risk factor method, and DCF method. Each tab represents a different way of calculating or estimating your company value, and together they give you a rounded view of what your business might be worth at the early stage of your company. The dashboard starts with a section called Key Investment Metrics. This is where the model gives you 3 critical numbers directly derived from your financial plan. The first is maximum equity. This is the maximum percentage of your company you could sell in this round. Selling more than 20% in this example in an early round is generally considered too dilutive and could send the wrong signal to future investors. The second is valuation cap. This is the maximum valuation the model supports based on your current financial plan. It tells you the ceiling of what you can credibly claim your business is worth, given your revenue, growth, and costs, planned obviously, in the next 5 years. The third is optimal raise here. This is the amount you could raise without selling more than 20% of equity. Together, these 3 numbers give you a very clear starting position for any investor conversation. How much you should raise, and what valuation and what percentage you should offer. Below Key Investment Metrics, you will find the investment scenarios and valuation section. This is where the model shows you what happens to your valuation and investor sentiment depending on how much equity you offer. You can toggle between a 12-month and 18-month runway view, which shows how much you need to raise to sustain the business for those periods. The table below then shows 3 scenarios based on different equity stakes. If we look at the 18-month tab, you will see that one of the sentiment changes to satisfy, as the valuation is getting closer to your maximum cap. In many cases, you may see rates like natural, meaning it's within the range of investors would broadly accept, or red flag, meaning investors may question whether the valuation is supported by evidence in your plan, or backing out, meaning the valuation is likely too high relative to your traction and investors may walk away. This is one of the most powerful parts of this section because it shows you in plain terms that the less equity you offer, the higher the implied valuation, and the more skeptical investors are likely to be. Okay, so now let's go back for a minute to our tabs at the top and talk about discounted cash flow method, the third and most financially rigorous method. This method calculates your company's value by projecting value of your future money and then discounting the money to today's value to reflect the fact that money today is worth more than money in the future. In this section, you will see 4 key outputs. Enterprise value, which represents the total value of the base business based on the projected cash flows. Cash in hand, which represents your current cash balance. Debt, which represents any outstanding debt. And equity value, which represents the value attributable to shareholders calculated as an enterprise value plus cash minus debt. The chart next to the figure shows free cash flow and discounted free cash flow by year, so you can visually see when the business is expected to turn the corner. So, which method should you use when talking to investors? The honest answer is all of them, but for different purposes. The dashboard ties everything together. It gives you the numbers that matters most. How much to raise, what valuation to put on the business, and how much equity to offer. And it tells you how investors are likely to react to your proposal. Having said all that, at this stage of the business, it all depends on how credibly will you create your model. But this is why we implemented AI analysts to help you get those numbers as close to realistic as possible. In this episode, we walked through the full valuation section, the dashboard, the 3 valuation methods, and the investment scenarios. We've seen how your financial model fits directly into valuation estimates, how different equity offers affects investor sentiment, and how tools like Berkus Method, risk factor method, and DCF method gives you multiple ways to defend your valuation. These sections, combined with everything we've built so far in the model, puts you in a very strong position to present to investors with confidence. In the next episode, we will look at creating an investor-ready pitch deck, because knowing your number is only half the job. The other half is being able to communicate them clearly and in a format that investors actually want to read.